Central banks do not buy gold on a regular schedule. They are not like ordinary consumers who might buy groceries on the same day each week. There is no set timetable for their gold purchases. Central banks operate in a world of shifting economic sands. Their decisions are guided by complex factors and a long-term view. Predictability is the enemy of effective central banking. If the market knew when central banks were buying, it could manipulate the price of gold. This would undermine the central bank's ability to achieve their policy objectives. Instead, they operate with a high degree of secrecy. Their gold purchases are often shrouded in mystery. Central banks are the guardians of a nation's monetary system. They must act strategically and discreetly to maintain stability and confidence. Their gold purchases are no exception. These purchases are carefully considered and executed with the utmost discretion. The timing and size of these purchases are rarely disclosed immediately. A myriad of macroeconomic factors influence central bank decisions on gold purchases. One key factor is inflation. When inflation rises, the purchasing power of a currency erodes. Gold, often seen as a hedge against inflation, becomes more attractive. Central banks may increase their gold reserves to preserve the value of their currency during inflationary periods. Another crucial factor is geopolitical uncertainty. Gold is a safe haven asset. During times of global turmoil, investors flock to gold as a store of value. Central banks may also increase their gold holdings to diversify their reserves and enhance their financial security. Interest rates also play a significant role. When interest rates are low, the opportunity cost of holding gold decreases. This is because investors earn less interest on other assets like bonds. Gold becomes a more appealing investment, leading central banks to consider adding to their reserves. Lastly, exchange rate fluctuations can impact central bank gold buying. Central banks hold reserves in various currencies. Gold can act as a hedge against fluctuations in these currencies. If a central bank anticipates a weakening of its currency, it may buy gold to mitigate potential losses. Specific events can trigger central banks to increase their gold purchases. Geopolitical crises often prompt a flight to safety. Gold, with its historical role as a safe haven asset, becomes highly sought after. Central banks may respond by accumulating more gold to safeguard their reserves. Examples of such events include the 2008 financial crisis and the onset of the COVID-19 pandemic. Periods of significant currency depreciation can also drive gold purchases. When a country's currency weakens, its central bank may buy gold to preserve its purchasing power. This is particularly true for central banks holding large reserves of foreign currencies. Gold provides a hedge against the declining value of these currencies. Furthermore, central banks may increase their gold holdings when they seek to diversify away from reserve currencies. This is particularly relevant for countries with large holdings of US dollars. Diversification into gold reduces reliance on a single currency and mitigates risks associated with geopolitical factors or economic downturns in the issuing country. Finally, central banks may buy gold to support domestic gold production. Some countries are major gold producers. Their central banks may purchase gold to stabilize the domestic gold market and provide support to local miners. Section 4. Discretion is golden. The shrouded world of central bank purchases. Central banks value secrecy when it comes to their gold purchases. Public announcements about large purchases could disrupt the gold market. They could lead to price manipulation and speculation, hindering a central bank's ability to acquire gold at a fair price. Instead, central banks prefer discreet transactions. They often work through intermediaries to mask their involvement in the market. Purchases are strategically timed and executed to minimize market impact. This approach allows them to acquire the desired amount of gold without causing undue price volatility. The timing of these purchases is rarely predictable. Central banks may buy gold at any time of day or night, any day of the week, and during any month of the year. There are no specific seasons or days favored for these transactions. This element of surprise is crucial to maintaining market equilibrium. It prevents market participants from anticipating and profiting from central bank actions. The confidentiality surrounding these purchases is a testament to the strategic importance of gold in central bank reserves. Section 5. central banks and their golden secrets, a glimpse behind the curtain. While central banks are notoriously secretive about their gold operations, some insights can be gleaned from their past behavior. The Federal Reserve, for instance, has historically been a significant holder of gold, although its purchases in recent decades have been limited. The Federal Reserve's gold holdings primarily serve as a legacy of the gold standard era. The European Central Bank, responsible for the Eurozone, has been a more active buyer of gold in recent years. The ECB's gold purchases reflect its efforts to diversify its reserves and enhance the euro's international role. The People's Bank of China has emerged as a major player in the gold market. China's central bank has been steadily increasing its gold reserves. This move is seen as part of a broader strategy to reduce reliance on the US dollar and enhance the yuan's global standing. Other notable gold holders include the Bank of Japan, the Reserve Bank of India, and the Bank of Russia. These central banks have different motivations for holding gold, ranging from historical reasons to diversification needs. Their purchase patterns are equally diverse and difficult to predict. Section 6. Conclusion: a market shrouded in gold. Central bank gold purchases are a fascinating and often opaque aspect of the global financial system. These institutions operate with a high degree of secrecy. Their decisions are driven by complex macroeconomic factors and a long-term perspective. The timing and size of their gold purchases are rarely disclosed immediately. This unpredictability is essential to maintaining market stability and preventing speculation. While some glimpses into their strategies can be gleaned from historical data, the world of central bank gold purchases remains shrouded in discretion and strategic maneuvering.